Half an hour into the start of U.S. trading, let's get a check here on the markets. Taking a look here at the major averages, the selling continuing. You've got your S&P 500 off over 2%. Your tech-heavy NASDAQ taking the majority of the hit here, down about 2.7% off of the back of that weakening economic data from that soft GDP print showing the contraction in the economy, the first quarter of contraction since 2022. But let's flip over to the bond market because it has been interesting to see this correlation breakdown happening. You are seeing treasuries catching just a bit of a bid at the front end of the yield curve, but still maybe those stagflationary concerns impacting the longer end of the curve. You've got your 30-year yield up about a basis point. Finally here, let's take a look at Bitcoin. It is down this morning nearly 2%, holding above that 93,000 level. I want to welcome in Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. And Jay, it is great to have you on. You'll be with me for the hour. I do want to talk about PCE. We're just getting this data crossing the wire here. U.S. March PCE price index rising 2.3% year over year, just a touch above the estimate at 2.2%. March core PCE price index rising 2.6% year over year, being in line with the estimate of 2.6. Price index unchanged month over month. The estimate was unchanged. Real spending rising 0.7% month over month, coming in above the estimate. Obviously running through all of those numbers here, Jay, to me that stands out a bit, that the spending is up. That was also up in the GDP data. Consumer resiliency, it's not going away.
Consumer resiliency not going away, and also maybe people rushing out to get things before these tariffs come and get implemented, whether it's shopping for a big ticket item like a car, whether it's those imports rising because we're trying to get everything done before tariffs hit. That is the pattern we're seeing. Will this continue? Probably not, but until we get some certainty in Washington, we know that there are major headwinds coming, and it's like we're preparing. Winter is coming in this case for the economy, and we saw it in the stock market. That took us for a wild ride in April. Still a little volatility to end the month, but we're trying to find that balance. And once we get more certainty, which I don't know if we're getting anytime soon, but the economic data coming in line, that's okay. GDP, we expected it to be lower. Is it a trend that's going to continue, or is this just us getting ready for these potential impacts on tariffs? That's what we'll be watching in the future. And
one of the questions I have for you, because I know you look at the technicals along with so much else, we saw a lot of buying over the past 5-6 sessions here, and now, of course, this economic data putting a lot of pressure on the market. Are we to trust any relief rallies? Because then the data comes in and says the party's over.
Well, for the traders, this is the greatest market in the world. I mean, if you went away in April and now you're looking at, we were down a little bit. But no, for a trading point of view, crazy. For those long-term investors, you just don't want to watch. The volatility has started to come down. The rally itself, that was a relief rally. We had a washout after Liberation Day, that Thursday, Friday into that Monday, where the S&P 500 was down over 13.5% in 3 trading days, and it looked like when the bond market started going nuts. Finally, Jamie Dimon, he made some comments, the president backed up, and we got that little bit of a rally. What we saw, though, with the tariff announcement was the worst case scenario. So when we went into April 2nd, Liberation Day, as they call it, watched after hours very closely. And I was on the phone with a reporter, it wasn't you, but another reporter, and I know, right? And the Wall Street Journal had reported that it was 10% tariffs across the board. The market was rallying. Where were we? We were 5,500 in the S&P 500. Where are we now? Just under 5,500. That, to me, is the barometer of health for now. And we rallied on 10% across the board, and then we saw, that little chart that kind of befuddled everybody, angered the market. So worst case scenario, we sold off. We got down to over 20% intraday, never closed down 20%, so bear market avoided if you want to go by the book, but 65% of the S&P 500 stocks were down 20% this year. That's a bear market. So this rally was an oversold bounce, much needed. Hopes that now we're getting, constructive dialogue here, constructive dialogue there, and we can build from that. But we are not out of the woods by any stretch of the imagination. Technically, a lot of damage. This was a nice oversold rally. We held 5,100. That was a key Fibonacci level that I was watching. We probably will not retest those intraday lows around 48.50. So let's look at 5100 as a new floor and try to make a higher low from there. But expect things to be volatile as headlines come out, tweet by tweet, minute by minute. The good news is they've been kind of quiet. We've got some great earnings. We're going to focus on them. We'll talk about a few of them in a little bit.
Yeah.
So if we can focus on earnings, that would be great.
But, and it's interesting you bring that up because earnings have also had a bit of a negative tint to them, given the fact that I think over 90% of companies reporting so far have mentioned tariffs and the uncertainty surrounding them, understandably.
Yes.
Where do we head from here then? Can earnings hold up in the face of uncertainty?
No, we tread water for a little while. I mean, if anyone's expecting us to get back above the 200-day moving average at 57.45 and, everything all clear, we're not going to get that all clear. We may get tariff negotiations, but then we have to wait a quarter to see how these companies adjusted it. Some companies, GM, cut guidance. We may hear tomorrow from Mary Barra if they're going to reinstate that guidance. But how can these leaders of companies give crystal clear guidance on their future and not know what the tariff situation is? So they're put behind the eight ball. It's not fair to them. And then the investor looking for, hey, this is a safe investment. They're doing great. That's, to me, is interesting. It's going to be great to talk to the bookings CFO.
Yeah.
We're seeing guidance, but it's not optimistic. It's hopeful. We wait, we get clarity, then we go, and that's the best they can do right now. So we'll just probably have to tread water for a little while longer, hope that things don't go south with this trade war, and sideways is a direction. It looks like we're going to be in it for quite some time. All
right, great overview as always, Jay. Glad you'll be sticking with us for the hour for more of that fantastic context. Let's turn now to President Trump telling Congress to slash taxes at his rally celebrating the first 100 days of his second term.
In the coming weeks and months, we will pass the largest tax cuts in American history, and that will include no tax on tips, no tax on Social Security, no tax on overtime. It's called the One Big Beautiful Bill, and it will be the biggest bill ever passed in our country's history.
The Trump administration touting these tax cuts as a way to ease some of the pain caused by tariffs. How realistic is this plan going to be? Joining us now to discuss, Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence. Nathan, great to have you on here. So I want to talk about this July 4th deadline. That is the GOP's new target for the mega bill, according to Treasury Secretary Scott Bessent. To what extent does that mean that we will get clarity on tariff policy between now and July 4th, given the idea that the revenue from tariffs could potentially be a way to pay for all those tax cuts in that July 4th bill?
So I don't think you're going to see much in the way of clarity on the tariff argument because they're almost two separate issues. Obviously, President Trump loves to say that he's going to use tariffs to pay for this tax reform, but Congress isn't exactly thinking about that. Now, this is a $5.3 trillion bill. The bulk of it goes to extending the 2017 Tax Cuts and Jobs Act, but there's about $1.5 trillion in additional, like President Trump was saying, no taxes on tips, no taxes on Social Security. But the question that we have from the investment point of view is, yes, you have these tariffs going on, but what else do you have to cut to help pay for that? And that's primarily coming from Medicaid, SNAP benefits, and the Inflation Reduction Act. So even though President Trump can say that he's going to use tariffs to help pay for tax reform, we still don't know the true extent of what these quote unquote deals or these memorandum of understandings that are occurring between the negotiators between the United States and these other countries. So Congress isn't exactly thinking about this tariff argument, but if this bill does come in sooner rather than later, I think you could see the White House potentially say, let's take a step back on tariff policy because the tax cuts are going to help generate economic growth.
Yeah, and I hear you separating out these different policies between tariffs and tax cuts, but then when we hear members of the administration talking about how tariffs are a revenue raiser as part of the way to pay for tax cuts, it's hard to not feel like they are lumped together. Talk to me about whether or not the need to use tariffs to raise revenue negates the idea that we may have tariff negotiations that make the tariffs less severe because the tariffs are a necessary revenue raiser.
Yeah, so, if you talk to the folks up on Capitol Hill, there's really no indication of how much they think is going to come in for tariffs. The economic lab up at Yale is estimating it's only collected around 2.4 billion, so that's billion with a B, and you're talking about a bill that's going to cost 5.3 trillion. But, the tariffs are not going into the reconciliation record, meaning tariffs are not being put in how you're going to pay for this bill. What the White House is saying is, look, we understand that you will have to pass this $5.3 trillion bill. Think of the tariffs coming from outside bit of this arrangement is helping to pay for that. And it certainly is going to give comfort to some of those Republicans that will ultimately vote for this, because one of our core scenarios is that when this passes, and we do think it can pass by the July timeframe, maybe not 4th of July, but definitely before the August recess, when this passes, we think that the deficit is going to increase substantially as a result of this, because we just don't see the pay-fors coming through the rest of the package actually getting the votes to pass the House or the Senate.
And Nathan, my co-host Jay Woods, has a question for you.
Hey, Nathan, thanks for joining us. We talk about that July 4th deadline. We've kicked deadlines down the road, so I think your recess is actually a good time frame for them to get this done. But how difficult is it going to be to pass? Because this was low-lying fruit, it seemed like, with the Republican administration to get that tax extension. Now it's muddied in the waters. So how much is this trade war going to hurt this tax bill going forward?
It's going to be extremely difficult. I mean, the margins in both the House and the Senate are extremely thin. And what the Republicans have essentially done so far is they've taken the easy road. They're just voting on resolutions. These are blueprints. But now they actually have to come out with the specific language. And that's what we're seeing in Congress this week with these markups. Now, what we're telling our clients is, look, Republicans are throwing the kitchen sink into this. So you're going to see a lot of different ideas, but eventually they have to be scaled back. But in terms of what you're going to see going forward is you are going to see continued negotiations of these tariffs. You will most likely see memorandums of understandings that will give the market some comfort. But the ultimate deadline of when Republicans have to pass this is the debt ceiling. And when Treasury comes out later this week or early next week with the new X date, which we think is probably late July, August, that's the deadline in which Congress has to get something done. Because if not, they're going to have to figure out another way to do the debt ceiling. And then that's just going to cause a lot of other problems because they're going to have to work with Democrats.
I also want to broaden the conversation a bit to talk about deregulation. This is something that Treasury Secretary Scott Bessent again has said is a policy sweetener that the market is discounting. To what extent are you telling clients that same thing?
So deregulation is something that there's a lot of sentiment, especially going into the election. There was a lot of sentiment that deregulation was going to happen, but there's really no magic wand. You can just say poof and say go forth and deregulate, with the exception of the energy sector. So if you're an energy sector client, there are things that President Trump can do via executive order that can move things up and move the process much quicker. But when it comes to things like financials, when Treasury Secretary Scott Bessent says they're going to do deregulation, there has to be a rulemaking process. Long story short is it takes about a year. Now, with all those agency leaders now coming into place and bidding confirmed by the Senate, we think these proposals are going to come out. So if you're looking at the big banks, for example, look for that proposals to come out later this year, and then ultimately reducing in capital, reducing leverage requirements to occur in 2026.
All right, Nathan, we got to leave it there. Thank you so much for making the time this morning. We're going to have all your markets action ahead here on Yahoo Finance, so stay tuned. You're watching Catalysts. It's now time for some of today's trending tickers. We are watching shares of First Solar, Yum Brands, and Volkswagen. First up, First Solar tumbling after cutting its first-year net sales guidance. The company's CEO noting significant challenges from President Trump's tariffs that he says weren't expected at the start of the year. Analysts at KeyBank downgraded the stock to underweight, noting that the company's overseas manufacturing exposure is larger than they initially thought. Jay Woods still here with me to break it down. So not the first company to cut guidance off of worries about tariff policies here, but you make an interesting point about how you look at solar in general.
Yeah, well, you knew coming into the Trump administration that this was not going to be one of those areas of focus.
Yes.
He's not looking to help these clean energy stocks by any stretch of the imagination. And First Solar, if you look at it historically, technically, every rally, unfortunately, has been an opportunity to sell stock. And the stock is now going towards its 52-week lows around 116.5. It's down 29% for the year. We had a nice rally last week in the solar stocks. There was some positive news there, but unfortunately, the guidance, as expected anywhere, is cloudy. And we're not, we're not a believer that this story and solar stocks are going to turn around anytime soon. Unfortunately.
Yeah, awaiting clarity is the name of the game here. But next up, Yum Brands revenue falling short of the street's expectations in a mixed first quarter as Pizza Hut's same-store sales fell more than anticipated. The pizza chain's performance was weakest in the U.S., where same-store sales slid 5%. Taco Bell, meantime, a standout during the quarter. Same-store sales up 9%. Despite the revenue miss, Yum Brands beat estimates for adjusted earnings per share. You can see those shares down about 0.5% right now. Really interesting takes on the consumer here, because the Taco Bell strength could potentially be a recession indicator. People, I mean, you can get a lot for not a lot of money out of Taco Bell.
Taco Bell is a staple, you know, especially for those college students late nights. But yeah, and a Pizza Hut. I haven't seen a Pizza Hut in ages. That brings me back to my childhood. But Yum Brands overall, not as bad as people anticipate. They did have a solid quarter. They're doing well internationally, where people were a little surprised in that, okay, this anti-American sentiment maybe will stop going to these American brands. But they've been doing all right. And then in the consumer staples sector, they're holding their own weight. It's a dip here, but given the uncertainty everywhere else, I don't think Yum Brands is a bad place to be right now. Of course, the guidance isn't going to be rosy, like we discussed with every stock we'll mention today. Who knows what we're doing? But these staples do well. The Taco Bell brand is one not to mess with, and those results are solid. So Yum Brands is not a bad place to kind of hide and avoid some of this overall volatility in the market.
Yeah, amongst the consumer names, maybe it's one that has a touch of resilience, to your point there. Let's look at Volkswagen, though, reporting a 37% drop in operating profit in the first quarter as the auto industry attempts to navigate President Trump's tariffs. In its forward guidance, the carmaker says it expects its net cash flow to come in on the lower end of annual forecasts, thanks to political uncertainty, none else. On Tuesday, President Trump signed an order easing some auto tariffs, though a 25% levy on all vehicles imported into the U.S. will remain. Tariffs on auto part imports set to begin by May 3rd will also go forward as planned. The stock down nearly 3% at the moment, but that over 30% drop in Q1 profit in a quarter where some others in the space potentially benefited from pull forward, that's not necessarily a great signal.
No, that's not a good signal at all. I mean, when people are rushing out to buy their autos, Volkswagen unfortunately wasn't on the top of their list. And the sector right now is a total avoid. Even when we get clarity, the margins are just too thin. It's not the biggest growth industry, if you will. I know Tesla is a standout there, and that's more of a power generation story than an auto story. But, you know, no surprise on the guide, still waiting to get that certainty. I mean, the fact that we have GM maybe giving guidance tomorrow, waiting 48 hours, is a sign of what these CEOs at these auto dealers are dealing with. So for me, the auto sector is an avoid, and it's not a surprise to see Volkswagen down 3% today.
All right, Jay, thanks so much. Great insights as always. And you can scan the QR code to track the best and worst performing stocks at Yahoo Finance's trending tickers page. Well, Snap declined to provide guidance for the upcoming quarter, citing uncertainty over evolving macro conditions and the impact on advertising spend. Here to discuss the broader landscape for social media ad spend, we are joined by Jasmine Enberg, eMarketer VP and Principal Analyst. Jasmine, great to have you here. So Snap talking about this ad revenue under pressure already because of a pause in spending from its customers, but that wasn't really an issue for the likes of Alphabet. Is this a Snap-specific problem?
It's certainly not a Snap-specific problem, but Snap is more susceptible to overall volatility within the economy because it is a smaller player in the digital ad market. We're expecting Meta will report earnings today, and I'm expecting similar dynamics from Meta like we saw at Snap. However, eventually and ultimately for Meta, the impact will probably be less than it is at Snap because it is an essential part of advertiser budgets. It's a must-buy for advertisers. So even in times of economic volatility and uncertainty, while we could certainly and probably will see a slowdown, it won't be as severe as for a smaller player like Snap.
And talk to me then about the extent to which Snap may be a bellwether for Meta earnings coming up after the bell here.
Snap certainly is a bellwether. I think it gives us a good look and an early picture of what is going on within the digital and social marketing market overall. And what we saw is that it was a very strong Q1 for Snap. Again, I'm expecting the same for Meta. But there is a lack of visibility and a lot of volatility going into Q2. So we can expect similar stories from Meta and other social platforms that are reporting later.
Hey, Jasmine, this is Jay. There were some bright spots in this call. I mean, if they reported this quarter without the tariff uncertainty, we'd be probably talking about up 10 to 15% on this stock. The one that stood out to me was monthly active users continues to impress. Could this be a buying opportunity? What are the positives you're seeing out of the results themselves besides the continued uncertainty in the market?
Yeah, absolutely. There were several bright spots in Snap's earnings report, and one of them, of course, was the growth in monthly active users. The one thing I would say there, though, is that a lot of the growth came from outside of North America, which is Snap's most lucrative market, and we actually saw a drop in daily active users in North America this quarter. And so that results in, a significant disruption to its usage, and a lot of that probably has to do with the fact that Snap was undergoing a test of a new design of its app. It also said yesterday that it would stop that test as a result of some of these disruptions.
And talk to me specifically about a component of Meta that I'm interested about, which is that 20% of Meta's revenue comes from China. We had data overnight showing major signs of economic pain there. To what extent can Meta continue to beat earnings expectations if the Chinese economy continues to be under pressure?
I mean, Meta is heavily exposed to a pullback from Chinese advertisers. On the other hand, though, it does have a very strong base of domestic advertisers, specifically small and medium-sized businesses. That's actually a group of advertisers that we're seeing a lot of the other social platforms going after right now as they're looking to diversify their ad businesses. Snap is included in that, but we're also looking at platforms like Pinterest, Reddit, and even X that are trying to court these small and medium-sized businesses. Meta also has a very strong performance direct response advertising business. And as we head into periods of more economic volatility, more economic uncertainty, what we see is that all advertisers start to prioritize the lower funnel. They start to turn to platforms that are tried and true like Meta and that also provide consistent ROI.
And I want to end a little bit more broad here because I was looking at a stat that one of our producers flagged this morning showing that tariffs could ding U.S. ad spend by as much as $10 billion. Top level here, who do you think is the biggest winner and who do you think is the biggest loser of that potential stat?
Well, this is looking at social ad spend. And again, if the tariffs continue to wreak havoc on the economy, what we will see is that Meta will fare much better than many of these smaller social ad players. We are expecting that there could be a $10 billion drop in the market for the amount of spending we're expecting to go to social ad platforms this year. But I think the really important takeaway from this graphic is that regardless of what happens in each of the three scenarios that we have proposed, social ad spending will still continue to see growth in 2025. And I think that's just a broader reflection of how important social media has become to advertiser strategies and the fact that social ads are incredibly easy to pull, but they're also very easy to turn back on.
All right, Jasmine, got to leave it there. Thank you so much. Appreciate it.
Thank you.
We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts. Take a look at the U.S. dollar, catching just a touch of a bid this morning after a theme of weakness for the greenback here as trade tensions ease, with President Trump signing orders to soften the blow of his auto tariffs and Commerce Secretary Howard Lutnick teasing that the administration has reached its first trade deal. Joining me now, Mark McCormick, TD Securities Managing Director, Global Head of FX and EM Strategy. Mark, great to speak with you here. I know that you are anticipating more downside to come for the U.S. dollar for the remainder of the year, but what could a potential breakthrough for the dollar look like?
So I think, especially in FX, you have to think about markets are driven by very different dynamics in the short term versus the medium term and the longer term. So what's kind of happened in the very short term is a lot of it's really based on positioning, technical momentum, and other things that might drive flows. I think what we've seen here is there's a tremendous amount of bad news priced into the U.S. dollar, into U.S. assets in general. And I think what markets are trying to figure out right here is that while there could be some stand down in the trade rhetoric and some stand down and try to find some trade deals, the most important thing is the effective tariff rate is going to be above 20%. So we're moving into a world where there's going to be a lot of uncertainty, a lot of complexity, a lot of volatility, but the reversing of the U.S. trade deficit requires a reversal of financial globalization, which at the core of it is where U.S. equities and where the U.S. dollar lies. So they are going to be collateral damage to any adjustments to the trade deficit. But that's not what's happening in the short term.
And talk to me then about what does drive the short term, given all of the uncertainty, given the lack of clarity on tariff policies, and then also as of this morning, what's actually moving a lot of the tape is that economic data. It's not those headlines on tariffs.
Right.
So which of those two is going to drive the U.S. dollar more?
It's a great question because I do think, again, we have to step back from what's happening, again, in the months and quarters ahead versus now. What's happening now is that when you look at positioning indicators, we run a whole lot of models and a lot of different tools to tell us what's going on in the very short term, longer term, medium term. But our positioning and short term valuation models are extremely short the US dollar. So we are like seeing a max discount being priced into the dollar. That means that a lot of bad news is priced in, and the market's got to continue to watch data. So whether or not Q1 GDP was good or bad is irrelevant because we know that the market positioned for short US dollar and short US equities in the first quarter. What matters is where things are going in the second quarter, whether or not what's priced in now matches the reality of what's coming through in the second quarter. And that's where we think the market's wrong. This is where we think the dollar is going to consolidate. Again, we saw some data today that's a little bit better than expected. We think non-farm payrolls will be slightly better than expected. And what that's going to do is what I would say here is what's very critical to the working the FX market is that what's happened is that international investors, pension funds, sovereign wealth funds, private investors, all these institutional investors have been long U.S. equities relative to other benchmarks. They have been forced out of those positions. I think most of this, again, in first quarter was mostly CTAs and really high frequency trading. But what's happening is that as the US dollar declined with US equities, they were doubly exposed to these positions, which I think have forced a lot of different investors to increase their hedges to things they're normally not hedged to, which compounded the losses in the dollar recently. So if anything, we start to see the US equity market stabilize, that will help stabilize the correlations and conditions for the dollar, which would allow the positioning and the consolidation of some of the FX markets to work through for the next couple of weeks, maybe even say through the early part of Q2. If we do get this to work out, where the market kind of readjusts its positioning and dollar positioning goes from very short to neutral, we are now in a position to start selling the dollar again, which is where we think the playbook is going to be in the second quarter for the second half of the year as well.
Such a great overview, Mark. I do want to double click on one of the things that you mentioned there, which is the foreign demand. We had a headline crossing this morning, China sovereign fund cutting its exposure to U.S. assets. Obviously, this is a key question right now, the extent to which foreign buyers are fleeing the U.S. dollar. How are you thinking about that risk?
It's very important, and your metaphor is going to be a tub, right? The tub is filled with water, and the water is the pool of assets that have been invested in the U.S. And you're going to turn on the faucets, and things are going to come in or they're going to go out, depending on whether the water is being drained or whether there's water coming in. So if you think about the total stock of foreign investment, the most important thing that you're looking for in the currency market, from the international investment position, the balance of payments, and also the current account, all those three things balanced together. There are accounting mechanisms that show how money moves across the world. The thing that matters the most for those is equities. It's the pension funds, it's the sovereign wealth funds. And what people don't seem to understand is, even if you look at the data, the largest holder of US equities is actually Canada, and then the UK, and then other countries as well. So there are pension funds invested in the US equity market. And if you look at the biggest holder of US treasuries, it's Japan. And again, if people think a lot about what China's doing, but China's been divesting from treasuries for years. So again, the bigger players here, the thing that we can see is there's a weekly data that comes out from the Ministry of Finance in Japan that shows us the actual movement in capital flows. So we have not seen big divestment in U.S. treasuries from the Japanese. We've seen some forced selling. Potentially that could be year-end rebalancing that you see in Japan on a regular basis, or it could be, again, essentially the institutions are starting to sell U.S. treasuries as a part of, divesting from the U.S. We don't know the answer to that, but we know what the data is telling us. And there's very little evidence that institutional central banks are essentially divesting from U.S. treasuries from the weekly custody holdings that we get from the Fed. They don't tell us who's selling. They just tell us how much is being held at the Fed for central banks. So again, I think the story is a little bit overdone. I think the asset allocation that we're going to see in the quarters ahead is going to downgrade the U.S. That's going to lead to a weaker dollar and equity exposure and international investment outside the U.S. But I don't think that is what's happening now, and the flow data is not telling us that.
Yeah. All right, Mark, I love talking to you. Really appreciate the overview and amazing context for our audience. Thank you so much. Appreciate it.
Thanks for having me.
Coming up, we're going to get a gauge on the health of the consumer with the CFO of Booking Holdings. That's next on Catalysts. Booking Holdings topping Wall Street's expectations in its first quarter as international travel offset some weakness in the U.S. Meantime, the company adjusted its full-year forecast, citing uncertainty in the geopolitical and macroeconomic environment. Joining us now on the results, we've got Ewout Steenbergen. He is Booking Holdings CFO. Thank you so much for joining us this morning, Ewout. I want to start on a point that I'm seeing in a lot of the analyst commentary this morning off the back of these earnings, and that is a slight hint of weakness in room nights over the course of the quarter here. To what extent are you concerned that some of the macro uncertainty is weighing on consumers' ability to confidently plan travel moving forward?
Yes, good morning, Madison. Thank you for having me. First of all, we are very happy with our first quarter results. We had a strong start of the year. If you look at room night growth, you're mentioning that. Actually, we ended up slightly above the high end of our guidance range. So we grew slightly over 7% year over year. 319 million room nights we sold only in one quarter. So yeah, we sometimes have expectations running up too far ahead of the actual guidance that we have provided to the street. But actually, we reported numbers ahead of our guidance that we gave for the first quarter. Also, we saw revenue doing very well, 8% up. We had a lot of discipline with respect to our expense management, and therefore earnings per share was up 22% year over year, and that was far above the expectations of the street. We also returned 2.1 billion of capital to shareholders. So overall, good start of the year. We're actually very happy. And I think the results were also in general very well received by the market.
And one of the things I can't wait to get your take on is how exposed you are to international travel as opposed to domestic. How are you seeing the impact of the trade war weigh on consumer sentiment across the globe? And is it differing? Are you seeing international travel hold up and then domestic travel in the United States being under a little bit more pressure? Talk me through some of those differences.
Sure, Madison. And of course, we are monitoring this very closely. We have a big advantage that we are globally very well diversified. So about 50% of our traveler consumers are in Europe, about 25% is in Asia, and low double-digit level is in the US. We're seeing generally demand stable through the first quarter and also including in April. So generally stable trends, and that's really a positive. Yeah. We see a little bit of weakness in demand in the US. So the US is a little bit of an outlier compared to what we see in the rest of the world, although it is stable and not deteriorating in terms of demand in the US. So for example, what is happening in the US is shorter trips. We see people booking shorter trips, and also demand on the lower end of the market is weaker. So lower star rating hotels, 1 and 2 star rating hotels. So a bit of a bifurcation in the US consumer market. The top end is holding up quite well. The 4, 5 star hotel rated hotels, international travel is holding up better. But the lower end of the market, there's definitely signs of weakness in the US. Yeah. Again, we are not seeing that in anywhere else in the world.
And Ewout, my guest host, Jay Woods, has a question for you.
Hey, Ewout, first of all, great quarter. This has been a tough environment to navigate, and compared to your peers and seeing what we've seen in some of those, the airliners and the guidance they've given, I thought you handled it masterfully. Now, going forward, what is Bookings doing to try to keep those rooms booked at the rate you've been able to and to meet numbers going forward? Are you offering any special deals to the consumer? How are you staying above the curve?
Yeah, Jay, thank you so much for your compliments. We're doing a lot of things in terms of our strategy, where we are investing in order to keep the demand and, of course, to deliver value both for travelers and for our supply partners. So let you give you a couple of examples. We are investing a lot in flights and flight tickets. We had 45% growth in the quarter. We're investing in our loyalty programs, in performance marketing, in opportunities for discounting and merchandising. So that's what we're doing on the traveler side. And we're seeing travelers coming more often to us, booking across more verticals, different kind of products. They're coming more direct to us and to our platforms. So doing very well in capturing that traveler and really adding value to them. But actually, in these times where demand is a little weaker, particularly in the US, as I've said, we're actually adding more value to what we call our supply partners. Think about the airlines, think about the hotel owners, because they're having more difficult times to fill their seats and their rooms, and we can help them with additional demand by running very specific programs. So actually, these are the times our added value to those supply partners is going up, and we're creating more loyalty with them, and that is going to pay off over a longer period of time.
And just to follow up, and I'm going to put you on the spot, and this could be a question more for your boss, but at $4,900 a share, I'm sure you hear it all the time, have you considered a stock split? You haven't done one since a 1-for-6 reverse in 2003, since being added to the S&P 500 in 2009. You are now up there with Berkshire Hathaway as the most expensive stocks in the S&P 500. Is that something you think about, or you just don't even worry about the share price?
Well, and that's actually really also a question for me as CFO, of course.
Yeah.
But we are discussing that with the whole management team and with the board. It's not on the agenda today, Jay, because it doesn't in fact add a lot of economic value. There's only very small benefits. We have so much to do. We have so many initiatives across the board. We're investing in so many new areas to grow the business. That is more the priority for the near term. Maybe over time we can reevaluate that, but at this moment we are not considering a stock split.
All right, great overview there and great overview of the quarter, Ewout. Thank you so much for joining us, and thanks to Jay Woods for joining the conversation as well.
Thank you.
Coming up, we're going to take a look at what ETFs tell us about flows within Trump's first 100 days in office. Stick around. President Trump's first 100 days led the S&P 500 historically lower compared to past presidents, but our next guest says the ETF flows suggest investors still remain confident. I want to bring in Todd Rosenbluth, TMX VettaFi Head of Research for this week's ETF report, brought to you by Invesco QQQ. Todd, great to speak with you today. Obviously, a lot of volatility over the last 100 days, but what are the flows showing you?
Well, investors continue to embrace ETFs and equity ETFs and S&P 500-based ETFs. The Vanguard 500 ETF has already $50 billion of net inflows. That's on pace to break a record that it set last year with over $100 billion. We're on pace to have over $1 trillion again for overall ETF industry. We're seeing investors embrace some risk in going into the equity markets with ETFs. On the fixed income side, they're becoming much more defensive. Short-term, treasury-oriented products are what's been most popular thus far this year.
Yeah, and I wonder the degree to which you are sussing out which kinds of investors are participating in these flows. I want to take a listen into what Treasury Secretary Scott Bessent had to say about all of this.
Vanguard, one of the largest money management firms in America, said that over the past 100 days, 97% of Americans haven't done a trade, and in fact, individual investors have held tight while institutional investors have panicked. So individual investors trust investors trust President Trump.
Okay, so the point he's making, individual investors trust the president because they're staying invested. Institutional is the one that is responsible for the selling. Are you seeing data that support that idea?
So I don't want to get into politics and whether or not investors are trusting or not trusting.
Sure, but in the data.
The president. The data shows that investors that are long-term oriented, buy and hold investors, have been using the opportunity to take advantage using ETFs. Now, not necessarily in the equity markets. Obviously, the stock market has sold off and is still down 10% for the year. But Vanguard 500 is widely used by retail investors and advisors. We're hearing from many advisors at VettaFi that they're making some allocation shifts within the equity market as opposed to necessarily pulling out of the market. We've seen some income-oriented strategies, dividend products. Schwab Dividend was one of the more popular ETFs this year. JP Morgan has some covered call income strategies, JEPI and JEPQ, that have been popular this year. So we are seeing a rotation within the equity marketplace, but certainly fixed income investors that are hiding out in that ultra-short category. Vanguard's product, iShares, State Street, that's not a sign of optimism at all.
Yeah, and speaking of investors looking for safety, your dividend ETF is getting inflows. Are these record inflows that you're seeing? Do you feel that there's a panic that we have to shift into these dividend incomes? And then lastly, on the 3-month Treasury front, do you have an offering there that I'd like to learn a little bit more about myself, just to put something away on the side as well?
Yeah, so we are seeing investors embrace dividend strategies, the stability of dividend-paying companies or free cash flow-oriented companies. So I mentioned that swap dividend ETF that's been popular. Victory has a free cash flow ETF, VFlow, that companies that generate strong free cash flow have the ability to pay a dividend. And we are also seeing some of those short-term treasury-oriented products. So SGov is an iShares product. VBill is a Vanguard product. Those are both great ways to get exposure to the fixed income market. 4% yields, very low fees, keeps you invested in the marketplace in case you are worried about what's next.
All right, and I know that you also have actively managed ETFs that are getting some attention as well. What are those flows telling you?
Yeah, so investors, specifically fixed income oriented investors, have been embracing active management for years. There's now many more of those in the ETF wrapper. So PIMCO has had success. They have an ETF, PYLD, that has seen about $2 billion of net inflows just this year. That's been very popular. T. Rowe Price has an ETF, TAGG, that has also seen some strong inflows. Investors want fixed income exposure, but they may not want to manage it themselves. They want to lean on the professionals, and many of them are in the ETF marketplace.
All right, we got to leave it there, Todd. Thank you so much. Really
Thanks a lot.
appreciate it. And still with me is Jay Woods of Freedom Capital Markets. And Jay, I want to end the show by doing a couple of your bigger takeaways for where you see the market heading right now and what signals you are looking at most to suss out that market activity. Where is your kind of thesis for the market right now?
Well, right now it's the end of the month, so we may see a little more window dressing and try to break even for April. I'd be shocked if we do, but we did get a rally after that PCE number. And then earnings. We've got big ones on tap. We've got Meta, Microsoft, Apple, and Amazon. Say that real fast, five times.
Yep.
And that will give us a bigger picture on the CapEx spend, the AI story. That's the leadership that we've been lacking. Those are the big stocks that have taken us down. And that sets the table for 2 weeks for NVIDIA. When you talk about big stocks, you're trying not to say, oh, this is the most important stock in the world, but they're spending, and NVIDIA is the one that gets to benefit from their spend. So watch how NVIDIA reacts to their earnings. But each one will have their own story. Amazon, the consumer, Meta, the ad spend, Microsoft, the cloud. So it's going to be very fascinating to see how the street reacts to these numbers. I think the lows are in, but the choppiness is going to be here for a little while. And until we get rid of some of this uncertainty, get a little clarity here from the White House, the sideways volatile action is here to stay for a little while.
And about a minute left here. Last trading day of the month. We are currently on track for 3 consecutive months of downward pressure on the stock market. What happens after that? Historically.
Now, historically, well, you have everything you take in different contexts. But what do we compare this to? Is this 2022 a full-blown bear market? Yet to be seen. Is it 2020, COVID? I hear a lot of people talk, this is a V-shaped recovery, just like we saw in COVID. Very different this time. And that V-shaped recovery in COVID, it took us 2 months to get back to the 200-day moving average once we got below it. We're a month in, so watch 57.45. Let's see if we can get back to the 200-day moving average. It takes time. So I don't think this recovery is going to be sharp and snap back and then all is well. All the guidance continues to be unclear, uncertainty. Until we can get a little more clarity, it's going to take quarters to get us back to where we were. So this could be a lost year. You don't like to say that because that makes great clickbaity headlines. Analyst says lost year. But that's where we're heading right now. And if we can just stabilize, we saw worst case scenario with the tariffs. As long as we don't get anything worse than that and these earnings keep coming out the way they are, I think we're going to be fine. We're just going to have to digest this for a little bit longer, and then second half of the year when I come back, we'll talk about how we're going to make a run at all-time highs.
There you go. Jay Woods, thank you so much. Thanks for joining me for the hour. Keep it here for more coverage on wealth dedicated to all your personal finance needs next.